Okay, so the market's bouncing back, right? And it feels good. Maybe a little too good. It's really tempting to just breathe a sigh of relief and think the worst is behind us. But here's the thing, there's something happening just under the surface, a really critical piece of the puzzle that almost everyone seems to be missing. So let's dig in and figure out what's really going on.
And this quote right here, it just nails it. The bounces are continuing, but it seems like nobody understands the most important thing in the background. I mean, that's exactly what's happening. We see the green on our screens, we see the numbers going up, but the why is super complex. The foundation for this whole thing is shaky, and the real danger? Well, it's hiding where most people aren't even looking.
So, let's ask the obvious question. What kicked off this rebound? Where did all this sudden optimism come from? Well, the main engine behind this move has been the news flow coming out of the Middle East. It really all comes down to what looks like a de-escalation between the US and Iran. And the market? Oh, it has jumped all over that, treating it like a massive green light.
Okay, so here's a look at the actual negotiations. It's a bit of a back and forth. You've got the US putting a 15-point plan on the table, mostly focused on stopping Iran's uranium enrichment. Then you have Iran coming back with their own list of 5 demands, things like controlling the Strait of Hormuz and, of course, ending sanctions. Now, on paper, it looks like they're miles apart, but, and this is the important part, they're talking. The lines of communication are open, and for the market, that's what matters.
And if you want to see how the market is voting on this, just look at this number. Negative 46%. That is a massive plunge in Omani crude oil. We're talking from a peak of $170 down to around $93. What does that tell you? It tells you the market isn't sitting around waiting for some official treaty to be signed. Nope, it's already placing its bets, and it's betting big on de-escalation.
All right, so that's the catalyst, right? The geopolitics. Now let's pivot and look at how Wall Street is actually reacting. The rebound is real, you can see it in the prices, but when you start to peel back the layers, you realize this whole thing is built on some pretty shaky ground.
I mean, at first glance, everything looks pretty good. The S&P 500, the NASDAQ, they're both bouncing nicely. But here's the problem. They're still stuck below some really key technical levels, specifically the 200-day moving average. And for a lot of traders, that is a huge red flag. It's basically a sign saying, hey, don't get too excited. The bigger downtrend might not be over just yet.
And this chart tells a fascinating part of the story. Even as prices are ticking up, look at what retail investors are doing. Their appetite for risk has absolutely cratered. It's at a minimum. So the everyday investor, they are not buying into this rally. They're sitting on the sidelines, hands in their pockets, waiting for a clearer signal.
So this leads us to this massive contradiction, right? You've got prices going up, but the overall market feeling, the sentiment, is still stuck in extreme fear. That is a serious disconnect. And what it suggests is that this rebound isn't being fueled by some broad, confident belief in the future. It's being driven by something else, something a lot more fragile.
Okay, to really see how all these forces play out in the real world, let's zoom in on a single company. Let's talk about what just happened with Circle. Their story is a perfect case study and why you can't just read the headline. You've got to read between the lines.
So get this. Just yesterday, Circle's stock got absolutely hammered. It fell over 16% in one day. We're talking more than $5.6 billion in market value just gone. A really brutal drop. And at first glance, the reason seems super obvious. But as you can probably guess, that wasn't the whole story.
So the question is, what really happened with Circle? Was this just a knee-jerk reaction to some scary headline, or did the market sniff out a much deeper, more fundamental threat that most people completely missed?
Okay, here's where it gets interesting. There are 2 parts to this story. First, you have the public reason for the drop. A draft bill called Clarity came out, and it could potentially threaten the business model for stablecoins. But then there's the hidden reason, the thing that the smart money was really paying attention to. Their #1 competitor, Tether, announced they're going for an audit from a Big 4 accounting firm. Now that is a huge deal. It's a massive step towards becoming legitimate and a flashing sign that they're planning to come and compete right on Circle's home turf in the US.
And you really have to understand the difference between these two to get it. Think of Circle as the institutional player, the pretty face of stablecoins, all buttoned up and regulated. Tether, on the other hand, is the offshore behemoth, operating in more of a gray area but with this insane global reach. The thing is, both are super important for the goal of dollarizing the world. But the idea of Tether cleaning up its act and entering the regulated US market, that's a total game changer. The market sold off not just on a draft bill, but on a fundamental threat to Circle's entire business advantage.
All right, Let's switch gears and talk about Bitcoin. Because just like the stock market, it is caught smack in the middle of a major tug of war. You've got powerful forces pulling it in both directions.
So here's a quick look at the battlefield. For the bulls, the optimists, you've got positive flows into the ETFs, and the on-chain data is starting to look healthier. They're eyeing a target of $76,000 to $78,000. But the bears, the pessimists, they see a huge wall of resistance between 72 and 74K. And they're warning that if support breaks, we could easily see a drop back down to 50,000. It's a real standoff.
And that leads us to our final point. And honestly, it might be the most important one. We've covered the rebound, we've talked about the risks that everyone sees, but what about the risk that nobody's talking about? What's that problem that's quietly bubbling up just below the surface?
So it really looks like the main thing that sparked this whole rally, that geopolitical tension, is starting to fade. And that should be the all-clear signal, right? Time for the markets to just keep climbing. But there's always a but, isn't there?
Because the turbulence is definitely not over. You know, the next crisis almost never comes from the place everyone is staring at. And it's all eyes shift away from the Middle East, another problem, one that could be even bigger, has been quietly growing in the shadows.
And here it is. The two words you really need to get familiar with: private credit. So what is it? Simply put, it's loans to companies that don't come from regular banks. Now, this market has absolutely exploded in size. It's mostly unregulated, and now we're starting to hear warnings that the whole thing is getting out of control. This right here could be where the next big systemic risk is hiding.
So that leaves all of us with a really critical question to think about. It's so easy to get caught up in the day-to-day headlines, right? Geopolitics, what the S&P did today. But while all of our attention is fixed on that show, is the real crisis, the next big one, quietly brewing somewhere else entirely?